So, yeah, welcome to Longview Conversations with. This is our second episode. Absolutely thrilled to have Jonathan Payne with us from Australia. Hi, JP. How are you doing?
Very well, Chris, and thank you very much for the invitation. It's always nice to see your cheerful and smiling face. Lovely to see you.
It's lovely to see you too, and I'm always interested to hear what you have to say about life. We've known each other a long time, of course. So I think probably we were saying just now back in 2009 is probably when we first met. I think
I believe so.
At that well-known Australian conference, Portfolio Construction Forum, run by that great friend of ours, Graham Rich. And
yes.
If I remember rightly, we were sitting on a panel together, and we were debating in 2009 with you, me, and Hamish Douglas of Magellan, whether or not it would be a L, V, or W type recovery. Do you remember which you went for?
You know what? When in 2009, when in 2009, was that the end of or beginning?
I think it was August. I think it would have been August. Would be my guess, the August one, because I'm not even sure you had the February conference then.
No. So I would have probably got it wrong. I don't think I would have said a V. But then again, it wasn't a V, was it, Chris? From 2010 was pretty soggy, wasn't it?
Yeah, we had the Euro crisis. Yeah.
Yes, we went into the Eurozone crisis 2011, 12. Was I an L? I don't even remember, actually. What was yours?
I don't remember either, but I'm pretty sure I nailed it. But no. No, I don't remember. I think the reality was it probably wasn't a W. Although you could argue you could argue as all of those letters, couldn't you?
I was definitely a W. I was definitely a W, Chris.
Okay. In perfect economist land, you could argue all three were correct, couldn't you? Which is the wonder of economics. But let me just quickly explain to people your background. In fact, why don't you explain to us your CV? And because you have a wealth of experience and you've worked all over the world in all sorts of places, and now running your own gig, independent operator, saying exactly what you want to whoever you want, which is wonderful. But just run us through where you've worked in the world and where you've lived in the world, because there's a lot of it in a good way.
Sure. Okay. Very briefly, I was actually born in South Africa, left there when I was very young, moved as a very young child to Lesotho, then on to Swaziland. Then my father dragged me kicking and screaming to the United Kingdom, Chris, to go to university.
Shocking.
Anyway, I started in the City of London in August 1984 as a portfolio manager, I think described as a global multi-currency fixed income portfolio manager for a company that no longer exists, manufactures Hanover, Manny Hanny, for those of you that are more my vintage. Absolutely loved every second of it. Couldn't believe they were paying me. I absolutely loved it. London was just an enormous amount of fun in the 80s. And then in 1986, I actually went to Bahrain, worked for a group called Gulf International Bank, which was owned by all the various nations that comprise the GCC, Gulf Cooperation Council. Absolutely loved my time in the Middle East, traveled very extensively, really enjoyed that. Then briefly back to London with Paribas Asset Management for 2 years. And then Gulf International Bank called me one day and said, you need to come home. And those are their words. I went back to Bahrain from 92 to 97, and I headed up the investment team there. And then in 97, the Rothschilds asked me to come all the way here to Australia and to be the chief investment officer of Rothschild Australia Asset Management, because they told me at the time they needed someone with more of a global perspective. Anyway, I left them in 2002 and then joined a group called HFA Asset Management up until from about 2006 to 2009. And I went independent, Chris, in about 2009. And as you know, what I do.
Yes, yeah. And since then, been making fabulous calls. Since then and before then, of course, you called the pandemic wonderfully, the sell-off and the bounce, I believe. You certainly called the global financial crisis very well. It's a great track record, and much more to it than that. And so it's actually fantastic to have you on the Longview podcast. As I said, our second guest. Always the second position, I think, is the most esteemed position in life. So I appreciate that. But what a wealth of experience. I mean, across the globe, working for all sorts of different companies from different nations. So very interesting and adds to a fascinating perspective. So why don't we, and by the way, I need to introduce your dog, don't I? What's your dog called?
Well, Charlie.
And Charlie's a huge fan, I believe, of you on CNBC, as we're going to put up in this photo now. Charlie watching you on telly not too long ago. Very appropriate, inappropriate response. Apologies. Yeah. So fantastic. So Charlie, of course, made Bath. That's the reason for mentioning Charlie. He may want to get in.
He might actually even come over here and ask to be taken out. But anyway, just apologies in advance. He's rather large. He's on the sofa directly behind me at the moment.
Okay, we'd love to see Charlie, and I hope he makes an appearance, and interested to see what he has to say about life. So fantastic. Fantastic. Let's dig in. As I mentioned, I'm going to ask you one or two quick questions that you for sort of a quick answer, and then we'll get into how you think about life and talk about some views. That'll be really fantastic. So let's start with a simple question. Which professional discipline do you think makes the best traders and investors? And by that, I mean, do you think engineers who think about the way the world is constructed, or economists, or psychologists, or doctors, linguists, mathematicians? What would you plump for? Maybe none of the above. I'm just curious as to what you think would be. It's in a sense, of course, it's an insight into what really is the way you think markets operate, I suppose.
Well, that's a really interesting question and a terribly difficult one to answer. I would rule out instantly economists. Clearly,
I thought you would.
I mean, when you look at the general track record of the world's leading economists in the last 38 years I've been in the industry, the record is not a good one. So I think psychologists would definitely have an edge, because I do believe there's just an enormous amount of psychology, but also the kind of contrarian who kind of understands and respects that, times such as 1989 in Japan, 99 tech bubble, so on and so forth. You get those periods of euphoria where the brightest and best get carried away and forget about all of their discipline and training. So a psychologist would probably be up there, and maybe actually an engineer or physicist or someone who can understand kind of, or those that specialize in non-linear dynamics or non-linear extrapolation. I think that's really the core to understanding financial markets.
Okay, so non-linear extrapolation and being a contrarian and being into psychology that's a fascinating insight. So when you say being a contrarian, give us a bit more color on what you're thinking there.
Well, I think Warren Buffett said it. The essence to successful investing is the ability or the capacity to divorce emotion from the investment decision-making process. And Chris, you and I have been in this industry a long time, and we've all met some amazingly smart people. And in each of those episodes, they kind of just got carried away. So the ability to be disciplined and not fearful of being a contrarian, because as we know also, the pack herd mentality is pretty suffocating, and if you stray from it, obviously you're subject to ridicule. If you stay right down the middle and you stay with consensus, well, it's kind of a relatively safe place to be. So I do believe that contrarianism and the ability, the courage actually to be able to stand up against the crowd, however smart they may appear to be, and just say, I don't agree with it.
And so how do you go about formulating a view other than just wanting to be contrarian? So I guess understanding where the crowd's at's important, but I guess there's a lot more to it in your thinking than that.
Yeah, it's an interesting way of asking the question. I mean, obviously, there's some benefits to being a contrarian. However, of course, you just don't want to be a contrarian for the sake of being a contrarian. I mean, that's obviously ridiculous. And there are times, of course, where the consensus expectation is appropriate, particularly between periods of severe dislocation. So my kind of philosophy, and I have a very, very, very simple approach to financial markets and economic and even geopolitical analysis. I treat, and I think you know this, Chris, I treat each day as a brand new massive jigsaw puzzle. And each day a new piece of the jigsaw puzzle arrives. And we've got to do everything we can to view that new piece of the jigsaw puzzle with a degree of objectivity and curiosity. Again, John Maynard Keynes, when the facts change, I change my mind. What do you do? I think all of us need to employ that each and every day. Yes, we need to know where the consensus is. We need to know what is priced in. That is absolutely critical. Then we've got to get a sense of the positioning in markets. And at the moment, that's absolutely fascinating because we know the hedge funds are generally pretty short. I'm talking, my reference point here is the United States. We can talk other markets.
Yep.
But generally, the hedge fund community are pretty short markets because, quite frankly, in my view, and I agree with them, the fundamentals are pretty appalling. But we can talk to that later. However, when you've got a lot of short interest in the market and we get these very sharp declines, you then get this reaction from the hedge funds where they have to take the profit. So they're buying back the market. And that's why we get these very sharp upward moves. And as you know, Chris, every bear market we've had, I mean, the big ones, obviously 2000, 2002, the next, obviously November 2007 to March 2009, we saw these very sharp, accelerated rallies, short covering rallies in markets. And we've seen a few of those this year already. So knowing where what I call the kind of big guns are and their positioning is always very useful. And Chris, I love my charts. So most people, when they look at my background and everything and blah, 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 economics and politics degree and masters in finance, they think, oh, you're a fundamentalist. You're only going to be looking at fundamentals, 24/7. Well, actually, yes, of course, I'm a data junkie. Yes, of course, I look at all the data points. However, I always complement them with chart analysis. And by the way, I'm an incredibly crude technician. And again, I've met some of the brightest people I know that are, converts to the Elliott wave, approach to technical analysis, and they get too immersed in it. It's almost a religion. And I think you've got to look at absolutely everything. And at times, the charts will give you the signal. And I think in 2022 so far, I think they've been really useful in terms of navigating what I believe is a bear market.
So in a sense, it's sort of, you take the fundamentals, you take the positioning in markets, the consensus narrative, and you take the charts and you wrap it all together in terms of coming together with that big jigsaw puzzle. What would you say, how's that jigsaw puzzle? What are the clues that you're seeing of late that you're focused on that are perhaps give listeners some insights into the sort of things you're focused on right at this very moment that are influencing your views?
Okay, I mean, if we can imagine a vast jigsaw puzzle, the first thing we know, Chris, is that you form your edges, don't you? You get those straight pieces and you form your edge. At the moment, the edge of our puzzle is a new geopolitical reality vis-a-vis, and I'm not the only one to be talking about it, there are others, obviously, what I've described as an axis of autocracy with Russia and China at its core, albeit I think that's fracturing at the present time, but we can talk about that later. So an acknowledgement and a recognition that the world has really fundamentally changed. And we can start the process of that fundamental change with the rise of Xi Jinping when he became president. And I was a bit slow to acknowledge that at first because I'm a bit of a China watcher. But the bottom line is we've got this rupturing in the geopolitical order. We've got this reality of this axis of autocracy. We've got this friendship with no limits. We know that because they told us on February the 4th, 20 days before Putin invaded Ukraine. And these two individuals want to challenge the post-war geopolitical order. Absolutely, full stop. And you could throw Taiwan into that. And that's a messy conversation. And we go down on all kinds of tangents when we go down that path. But the bottom line is the big picture has inexorably, fundamentally changed. First observation. So we have this process where we now, I think, are more inclined to deglobalization, having seen decades post 1989, the Berlin Wall coming down, of globalization. Globalization, I believe, on balance, was disinflationary, and the reverse of it, I think, is inflationary. You've got the disruption and dislocation in supply chains, which I think is ongoing. And this decoupling is inherently, I believe, inflationary as well. And then you layer on top of that the monetary and fiscal policy mix, and acknowledge first up, we've had this disinflation now for decades. We then had the COVID pandemic, which was the greatest accelerator and amplifier of any trends that I think any of us have kind of seen. It intensified, accelerated, and amplified so many things. So the acknowledgement that to survive the pandemic, not so much the pandemic, but the government response to the pandemic by implementing lockdowns globally, we've seen unprecedented fiscal and monetary stimulus, combined with the disruptive, dislocated nature of the global economy and deglobalization. And you have an inherently inflationary phenomenon taking place. Central banks, of course, go, nothing to see, nothing to see, nothing to see. Yeah. Oh, goodness gracious me. Oh, my word, we've lost control of inflation. We've got to respond. And I'm probably going to stop there because, but that's
that's fascinating. I mean, that raises a gazillion questions. I mean, I think my first question is, what would you, if you had to score central banks 0 out of 10, what would you give them?
Well, I have said in my reports, Chris, mirror, mirror on the wall, who is the most incompetent of them all? And it is a crowded and competitive field. I'm afraid I have to put ECB on the rostrum, gold medalist. And then I think, it's very hard. I mean, there's so many, it's a competitive field. So none of them have really covered themselves in too much glory. I mean, honorable mention, Chris, to the Reserve Bank of New Zealand that did start tightening a little bit earlier than the others. And actually, if you read the transcripts of their statements, they've all pretty much followed that line of thinking, which is in of itself quite interesting. I'm sad to say. I mean, I don't know how. Anyway, I won't look. The RBA certainly hasn't covered itself in glory. In fact, the RBA would be very close to the ECB, but I think we'll give the silver medal to the RBA, gold medal to the ECB in terms of those that have not covered themselves in glory, and then the rest follow thereafter. And that's interesting because I know you love to talk about the Wizards of Wall Street and all that sort of stuff, but all of this always reminds me of that great 1930s movie, isn't it? Or I don't know if it was made in the 30s, but it's about the 30s, isn't it? Is it Follow the Yellow Brick Road or whatever it's called, where they eventually, Doris, isn't it? Is it Doris? And eventually they get to the end of the Yellow Brick Road and pull back the curtain, and there's just an old man there cranking the wheels on the machine, which is slightly. It's interesting what you say, because you look at central banks today, they have got what I call Volcker religion on steroids. Having 6, 9, 12 months ago ignored the issue and talked about it as transitory, they've now, and in fact, perhaps apart from yourself, I think the only people that really forecast the inflation surge well were the monetarists. In which, and I think that's fascinating, because listening to Jerome Powell 2 weeks ago at the Cato Institute, he was making comments like, the money supply
is not really relevant to our monetary policy thinking. The relationship between inflation and the economy is unstable. Money supply and the inflation economy, and all this sort of dismissing money supply. Yet the people that got it right were the monetarists. So they've now got religion. They've now got religion on inflation. And there's really two obvious questions that come out of that. I think one is, what type of inflation have we got? Is it persistent and sticky, or will it dissipate quickly? And secondly is, what kind of damage do you think they may or may not have done to the global economy by the time they finish? Because I don't know about you, I don't want to project my views out there. I want to hear your views, but it strikes me volatility's on the up. Let's just put it that way in terms of the economy and other factors. So where do you stand on those two questions? What kind of inflation is it, and what kind of damage may they have done to the global economy?
Well, I think by the time they're done, they'll have broken quite a few things. And I think there's a kind of tragedy therein, but I won't dwell too much on the kind of blaming them for having seen what I think, Chris, was really obvious. And I'll try and be as constructive as I can. I mean, the Beige Book, which is a wonderful compilation from all the various Fed districts in the United States. It's a comprehensive compilation of, reports back from all, north to south, west to east of the United States. The Beige Book was screaming higher inflation from February and March. I'll say it again, February and March 21. And by the time we got to May, June, a publication that is usually rather conservative in its language was using language which shocked me as someone who's read every Beige Book since I started in the markets. I mean, I swear by the Beige Book, because
you could be the only one, JP, who's ever read that many Beige Books. It's very impressive.
I hate to say it, my first confession of the night. It's night here, by the way, for all your viewers. It's night time here in Australia. I have a terrible confession to make. I actually enjoy reading the Beige Book, and I actually read it more than once whenever it comes out. But anyway, the bottom line is the evidence was overwhelming. And also, I mean, businesses right through everywhere, and not just in the United States, all over the world. I have business contacts in Germany, in the United Kingdom, and they were telling me, my word, prices are just going through the roof. And I'd say, which ones? And I'd look at them all and so on and so forth. But the bottom line is they were so absorbed in, if we just digress for a minute, if we look at the Fed model, the US central bank, the kind of econometric modeling, it's all about linear extrapolation from the past into the future. So what has happened in the past will continue to happen in the future. And obviously post 2008 and 9, you had this quantitative easing. Yes, you had a bit of fiscal stimulus, nothing like what we had in response to COVID, but we must remember that. And they were saying, oh, no. We know what happens. Quantitative easing isn't inflationary. Well, the obvious difference, Chris, is, of course, the banking system in Western Europe and the United States was a busted flush. The transmission mechanism, between the US central bank and the economy was bust. So the banks weren't lending, companies weren't borrowing. It was just what we saw in Japan in the early 90s, where we had a classic Keynesian liquidity trap. And I said that at the time in 92, 91 in Japan. So here we are, fast forward to 2021, the banking system was robust, or is robust in the United States. In fact, probably the strongest shape any of us have seen. In fact, you look at their ratios. You've got this tsunami of liquidity being pumped into the system, the likes of which we've never seen anything close. I mean, Chris, you'll know the numbers better than me. What was M2 running at? 38% year on year or something?
Yeah. To about 30% at its peak. Yeah.
Yeah, combined with this gigantic fiscal stimulus and helicopter money, because money was going directly into deposit accounts. So it wasn't going via the credit system, but the credit system was robust anyway. So we had this most stimulatory policy setting, the likes of which we've never seen before. And then on top of that, you had the supply chain dislocations. And so you had diminished supply with an increase in aggregate demand, well, guess what happens next? Beige Book's picking it up. And that's why I kept saying please, Mr. Powell, read your own research.
Yeah.
And then he made a cryptic remark, I don't know when it was, 9 months ago or so, that, the Fed model couldn't deal with discontinuous events or something. I can't remember, didn't quite use the word dislocation. Well, anyway, here we are. So today, obviously, they now have to be seen to be Volcker-esque in their response to all of this. And I've said it for a while. They kept rates too low for too long, and they're going to keep rates too high for too long. And this higher for longer narrative now is very much consensus within the Fed. And I'm afraid they're going to break something. They always do break something. And we've never seen such a sharp rise in interest rates combined with such strength in the US dollar, combined with very high inflation that hasn't ended up in a real mess.
So does that mean you think the inflation is going to be short-lived, in the sense that this is not the 1970s? It's more like a pandemic, war-like money printing bout of inflation that quickly dissipates once the money supply growth is brought under control and growing at normal rates? Or do you think it is the 1970s?
Well, I'm finding it really challenging to find a precedent, to find the historical analogy, because I really do believe this one really is different. We've got a little bit of everything in this one. We've got a bit of the stagflationary 70s. We've got the geopolitical factors. We've got the oil crunch, energy crunch of the 70s, Yom Kippur War, so on and so forth. 79, 80, we had the Soviet invasion of Afghanistan, and we've got the Russian invasion of Ukraine. We've got a really hostile geopolitical environment. That's the outer frame of our jigsaw puzzle. And within the jigsaw puzzle, we've got some really interesting elements now. I mean, for example, clearly goods inflation in the United States is rolling over. It's migrating from goods inflation into services inflation. Within services, we've got some really sticky bits. Christian, you know them well. We've got shelter inflation, which is 32% of CPI. And that is trudging higher, because we know actual rents in the real world in the United States are 12, 13, 14% year on year. They were 18%, by the way, a few months ago, beginning of the year. So that takes time, as we know. We won't get into the weeds of how the BLS measures shelter inflation, because heaven forbid, Chris, I couldn't help myself one day. I was looking at the published shelter inflation, and I was looking at actual rents, and I went, I can't deal with this anymore. So I got hold of the BLS and I asked them to tell me exactly how they derived shelter inflation, or in particular, owner's equivalent rent.
Yes.
And I was horrified. Anyway, the bottom line is it's not in any way an accurate reflection of the real rents in the United States, but that's now coming through. So we've got this tug of war, goods inflation rolling over, and obviously used car prices and the like, which obviously the transitory school spoke a lot about a year and a half ago. But we've got shelter inflation pushing upwards, and food, Chris. We mustn't underestimate the unfortunate outlook for food prices, driven principally, Chris, by a very sharp rise in fertilizer prices. And this is all part of the dislocation driven by the Russian-Ukrainian conflict, and also, natural gas prices, which is so critical in the production of fertilizer. So I'm afraid food prices higher, shelter higher, and therein, I'm going to check my notes. Well, what, shelter 32%, foods 12% or thereabouts?
I think shelter's closer to 40, isn't it? But you're quite right. Just to complete your point, so owner's equivalent rent, it's worth explaining that most of shelter inflation is owner's equivalent rent, and explaining that is an imputed price. But which of course means that a data junkie somewhere works out what you would pay in rent if you rented your own house. That's the idea, isn't it? And I think, to your point, there's some sort of lag, isn't there, in the way that data comes through relative to real rents?
Well, at least 6 months, but also the actual phone call that takes place is, hello, Mrs. Smith, how much could you rent your house for? What do you mean? I live in my house. I don't want to rent it. No, but if you could rent your home, how much would you rent it for? I have no idea. Okay, phone goes down. So now 60,000 households.
Right, and this makes up a massive part of CPI. Now, to be fair, the Fed targets PCE, and PCE has a much lower weighting in shelter and ownership, but it's still very significant. So it makes you wonder, doesn't it? So what you're saying is they're basing their decisions on this inflation data point, which is Mrs. Smith, or whatever you called her, doesn't really know what her house rental value is. And of course, you're right, that's where the lag comes in as well, because she picks it up over time. She's hardly a sort of on the money, focused on how much her rental value is, because she lives there. She doesn't want to rent it. So that's a peculiarity of the inflation data. I mean, we don't want to overemphasize it, but what your point is, I think, is there's a whole mixture of factors coming into this, and shelter is one of those that's quite a peculiarity. So what do you think? So if I had to pin you down, would you be more in a sort of pandemic war money printing surge up and surge down of inflation, or would you be more in a stagflation 1970s style persistent inflation data sort of area?
Right. Statistically speaking, we're going to see a deceleration in the rate of increase in CPI from around the 8s. The drop down to 6 is going to be pretty easy because we've got the so-called base effects, right? But then the journey from 6 to 4 is going to be a little bit more problematic, and I don't know when we'll ever get back to 2. So that's the quick and dirty response. I do believe inflation will be somewhat more persistent, but I'm not suggesting we stay at these 8% type levels, because the simple mathematics tells me otherwise. However, don't forget the 70s, and this is what keeps Jerome Powell up at night, because the ghost of Arthur F. Burns, the Fed chair in the 70s, haunts him in his dreams, because, of course, Arthur F. Burns raised rates, thought it controlled inflation, then cut rates, then had to raise rates again, and then, of course, Paul Volcker arrived with the baseball bat to finally slay the American inflationary dragon. So I think we're going to see a mathematical, statistical deceleration in the rate of change, largely driven by the base effect. Plus, we've got used car prices dropping off, goods prices rolling over as well. No doubt about that. And we kind of head towards 6 quickly, start moving towards 4, 4.5, and then it sticks there for a while, because we've got shelter pushing the other way, which we've already described is a chunky part. Actually, shelter, by the way, is 32% of headline CPI. And then, of course, food pushing up as well. And we mustn't underestimate food. It's a global phenomenon. I know we won't have time today to talk about the kind of global food crisis, which I believe we are now tragically in, particularly for the developing countries. But, food and shelter combined is going to keep inflation rather sticky. So there has some hallmarks of stagflation. So I'm of the view we're going for a hard landing, no soft landing this time around, because it defies the kind of the extraordinary phenomena that we've just witnessed. This massive ramp up in money supply, massive fiscal stimulus. Now we've got quantitative tightening. And I think, Chris, you alluded to this earlier. These monetary aggregates, having gone exponential, are now absolutely plunging. So if you're a monetarist, and I've got a feeling you've got a few monetary genes in you, and I still remember, my monetary economics and the quantity theory of money. If velocity is reasonably stable, and I think the banking system is in reasonably good shape, now money supply rising sharply as a response to the pandemic, driving up inflation, increasing aggregate demand in a diminished supply environment, that by definition you create inflation. And shame on the economists, quite frankly, who didn't see that. And shame on the Fed. Chris, you know this. The Fed employs 400 economists with PhDs.
Yeah.
Anyway, so
it's troubling. I think you make an extremely valuable point. And I mean, I think if one's feeling ultra cynical, economics has got so much more it needs to progress. We call it a sort of social science, but at times it feels a bit like voodoo economics. I would quote you, Daniel Tarullo, who was on the federal governor's board for, I think, 8 years, left a few years ago. He was the lawyer, so he was more on the compliance side. He gave a fabulous speech, I don't know if you remember it, after he left, just explaining that when he turned up at the Fed, he was in awe of the models and the PhDs and the work they did. And by the time he left, he couldn't understand why they're so wedded to the Phillips curve, because it was clear to them, and he could see it was clear to them, the PhDs, that the Phillips curve didn't work, but they still used it. Now, I mean, I tell my father this, he's a physicist, an engineer, and a scientist. He finds it shocking. The evidence tells you something's not working, yet we stay wedded to these, which really frightens me. And I come back to your point about, one of our headline lines was, "We're all monetarists now," which is kind of what we should be. The bastardization of what Friedman said in the 70s, that we're all Keynesians now. And Nixon said it as well, I believe. But we should all be monetarists now. So to your point, I think M2 is contracting quarter on quarter at its fastest pace on record. Now that data, weekly data, only goes back to the early 80s, but it gives you a sense that money supply's peaked, it's contracting in absolute terms, and as you said, QT. So where does this leave you then in terms of, something's going to break, and you talked about a hard landing. How hard do you have a sense? I mean, these things are difficult to pin down, but what are your sort of what are your indicators and your sense of this market and this economy telling you on that? How hard may we see a fall in the US and global economy over the next 12, 18 months?
Well, I'm afraid we're going to have to go to Europe if we're going to start our journey of discovery through the prospects for recession. And it's very sad what we're seeing in Europe, but they're experiencing a once in a, I don't know, multi-generation energy crisis. Now, I know that electricity prices in Germany have rolled over from their exponential levels of 4 weeks ago. Natural gas has softened somewhat, but these are still at many, many, many multiples of what they were from 2010 to 2020. So let's be very, very, very clear that Europe is currently enduring an energy emergency, and you're seeing similar things in the United Kingdom, notwithstanding Liz Truss and her movement to cap prices. But I mean, Europe is going to be, I'm afraid, is in recession, and it's going to get worse because business confidence and consumer confidence in Europe is through the floor. I mean, I saw the latest consumer confidence numbers out of Germany. It was about a week or 10 days ago, worse than the pandemic panic low, and much further below where they were in the financial crisis of 2008 and 2009.
Yeah.
And I talk to people in Europe. I know you do as well. I mean, business confidence and consumer confidence is shot. So,
which is an extraordinary fact, is it? I mean, the fact that it's so low, what does that make you think? Because it surprises me in some ways.
Well, I suppose with the consumer confidence number, because of course inflation in Europe is sky high. I mean, in Estonia, don't quote me, I can't remember the latest data point in Estonia, it was up at 24, 25%. Funnily enough, just a few hours ago, Chris, what was the number? German producer prices came out just a few hours ago before we started our conversation. German producer prices are now running at an annual rate of 45.8. I mean, this is mind-boggling stuff. So, and then you look at companies like, one of the largest chemical companies in the world, BASF, that has the largest chemical plant in the world in Ludwigshafen in Germany. Ludwigshafen, the chemical plant, has over 60 miles of tar roads within the plant. So we're talking a ginormous facility. And they're in terrible trouble because, of course, natural gas is such a critical ingredient for the production of chemicals. And that's at the big end of town. I speak to small and medium-sized companies in Germany that are using the word catastrophic. And these are multi-generational private firms. These are not listed on the stock exchange, but these are the backbone of the German economy. And these businesses have been in the family for generation after generation after generation. And they're saying they have never seen these conditions before. So this is the reality of what's happening now. Obviously, we've seen some near-term softening in nat gas and electricity prices, but I'm afraid Europe has just suffered a seismic shock. So recession is guaranteed. And of course, the European Central Bank, having to respond to this extraordinary inflation, is now aggressively tightening rates. I mean, my goodness me, Chris, you remember 2008, they were the ones that raised rates in 08 when the writing was on the subprime wall for all to see.
Yes.
The ECB raised rates. And then during the European sovereign debt crisis, they raised rates. So they've gone 3 for 3. And that's why they get the Mirror, Mirror on the Wall award.
That's a fascinating point about Europe. And you mentioned that these companies you speak to haven't seen anything like it in generations. It just struck me, is there any time in your career, I think you started early 80s, something like that, when you've seen anything equivalent or anything as bad, or would you put this as worse than the GFC in terms of the background, the macro environment and so on, or just different?
You know, it's very hard for me to say which is worse. I just think Europe is suffering tragically a profound shock in every respect. I mean, you know, the industrialization of Germany and much of it is in the last 10, 15, 20 years has been driven by plentiful and cheap energy. And that's just been taken away. And they're doing a heroic job of diversifying their energy imports, et cetera, et cetera. We won't get into too much into that. But this is a profound shock because also it questions, quite frankly, the kind of credibility of prior governments in Germany. So for many, many decades, the German people felt that, they were on the right path in every respect. And this is a massive seismic shock, and it's amplified right through Europe.
Yeah.
So, I mean, of course, Europeans will come through this eventually, but you're going to have to see this very nasty recession first. And so, okay, so that's Europe. And then, of course, we've got China, Chris, and you and I have spoken about China over many, many, many years. But I've been a kind of a China junkie for more than 3 decades. And I've said this publicly, and I've said it in my written reports. I have never been so bearish on China as I am today. And really, I'll put it out there, Chris. I think the credibility and the legitimacy of the Chinese Communist Party is being questioned today more than I've ever experienced before. And I do also believe, and on October the 16th, we've got the 20th Party Congress, and Xi Jinping will secure a third 5-year term because he changed the constitution to enable him to do so. I said it, I think, the other day in one of my reports. I don't believe Xi Jinping will complete his third 5-year term. And I'm also somewhat optimistic that Vladimir Putin won't be there either in 5 years. But in China, I mean, you've got the property market is just one great big mess. The property developers, we all know the story. It started with Evergrande, but then now it's Country Garden. I mean, the jewels in the Chinese property crown in the private sector, and the state property firms are obviously now coming in to try and soothe things. But the Chinese consumer and investor has just experienced something they never thought they would: a complete loss of confidence in the housing market, which we know is what, 23, some even say 25% of GDP.
Yeah.
The numbers on house prices are being completely and utterly made up. In tier 3, tier 4 cities, the house prices are down very, very significantly in the last 12 to 18 months. We don't want to get dragged kicking and screaming into the nonsensical zero COVID strategy. But, right across China, Chris, Chengdu in Shanghai, right across China, we're seeing the masses basically rising up and challenging the authority and the legitimacy of the authorities. This is fascinating stuff.
This is a big statement you make, and interesting as well. You talk about the idea of credibility being undermined. I presume that relates to what you're seeing in the housing market and what you're seeing on the zero COVID. Is that, and we see all these protests about people not being able to pay their mortgage or get their money from their bank, but China has this brilliant ability, or has had this brilliant ability, to cover up all cracks, to paper over all cracks. And I suppose that the pushback you might get from that view, and I have a lot of sympathy with what you're saying, but the pushback would surely be that, China doesn't really have a lot of inflation, and therefore it has the ability to stimulate the economy and spend money and get beyond these problems. I mean, we always used to say that China was an expert at sort of easing and squeezing, which sounds like a highly inappropriate thing for monetary policy. But but basically, they seem to have had this ability over the years to sort of, whenever there's a problem, and there've been several, they've managed to deal with it. Does that? I mean, I get your point on credibility and on zero COVID, which I beyond me why they keep that policy up. But what is it? Is it zero COVID and what you're seeing in housing?
I think it's kind of all of the above, but let's just recap and re-endorse what you're saying. In the early 90s, they recapitalized the entire Chinese banking system. But in the early 90s, China was hardly, locked into, engaged in the global economy. Don't forget, China joined the World Trade Organization in 2001. And I was one of those China bulls. 2002 and 2003, I bored countless people senseless with my view we're going to see this extraordinary global economic juggernaut take off. And that was, fair enough for the next 10 years or so. It all changed with Xi Jinping because, of course, the supremacy of the party is absolute. He's a Marxist-Leninist and completely autocratic in every sense. So instead of all the reforms that we saw Wen Xiaobao and others implement, which made people like myself so optimistic, Xi Jinping arrived and said that that's all nonsense. The private sector is becoming more powerful than the party, and the party has to be at the core of Marxist-Leninist ideology. And so, of course, he started reversing that, and we saw the spectacular, disappearance on occasions of leading private sector individuals. But the bottom line is, right now in China, you've got this melee across the nation. Yes, you're right. In 2008, monetary and fiscal stimulus in China not only saved China, it probably arguably helped save the world. And that was one of the biggest monetary fiscal stimulations we've ever seen up until that point in time. However, this time around, Chris, the property market has broken. The confidence has broken. I would best characterize the Chinese economy today as being very similar to what I saw in Japan in the early 90s, which was your classic quintessential Keynesian liquidity trap, where it didn't matter how much money they pumped into the system. The companies had overborrowed, households had overborrowed, therefore they couldn't borrow anymore. And the banking system basically was terrified of lending anymore because they'd all been turned into zombies. So in China right now, private sector, there is the credit engine is shaking. Now the PBOC can inject liquidity in that, but at the end of the day, the banks are terrified because you've got all the big property developers have gone. The external markets aren't going to finance them anymore anytime soon. So the entire system is imploding upon itself. So I know it sounds rather dramatic, and Chris, for all your viewers who think I'm a China basher, for more than a decade, much more than a decade, I was one of the biggest China bulls on the street.
Yes,
But sadly,
and I remember that.
Compelling.
I remember that. It's absolutely true, and it's interesting in what you say. And in fact, some of the work we've just been doing on China, that some stats that might interest you is this sort of strange paradox in China. That if you look at the loan approvals index in China and the lending, it's going up. If you look at the demand for loans, it's completely collapsed. So something very strange is going on. And we had an interesting observation from a lovely lady whose name I completely forget, who's another huge China watcher, who made the point. And I think you would relate to this. You know, China, of course, sets targets. They say we're going to lend this much this month. And the bankers are like, okay, we've got to lend this much. And of course, the trick is you lend to someone at a rate and they deposit in your bank at this, and you give them the same rate so that no one loses, but you get your loan approval numbers up. So there's that debate going on in China. And to your point, I think transactions on housing are right on the floor at the moment.
Absolutely.
But yeah, it's fascinating what you say, because it's all about confidence, isn't it? It's that little, it's quite difficult to forecast and precisely pin it down, but when confidence goes, goodness me. And of course, there's some great stats that you'll know about how I think the top 1% in China own, I forget the exact number, 20 or 30% of the housing, something like that. So yeah.
Yeah, one more thing, and I'd probably get us both into trouble by saying this, but for the first time in a very long time, there is opposition to Xi Jinping within China. Yep. Now, clearly, the premier is retiring because he's abiding by his constitutionally mandated 2 terms, Li Keqiang. And I'm not even necessarily pointing the finger at him, but there is definitely a constituency within the party that is basically asking the question, okay, right, we've been so successful for so long. We lifted so many people out of poverty. Look at our wonderful infrastructure, world-class infrastructure. China's done really well. I mean, I used to sing their virtues constantly. What changed? Why is it that things are getting so weak? What's happening? Well, it's because we've got this very concentrated power in an individual. And we all know from history that China's association or experience with these extraordinarily powerful individual figures is not a happy one. And yes, there are people in the party saying, wait a minute, this is not really how we feel that the reason for our success is now changing, and this concentration of power. So yes, he'll get reappointed on the 16th of October, but there's definitely a growing constituency challenging. And by the way, within social media, which we know the Chinese absolutely crush any kind of commentary or dissent, they're finding it very hard at the moment to keep up with the suppression. So that I find rather interesting. There's a lot of unhappy voices in China today.
Yes, fascinating, isn't it? When the leaders and the elite of a country don't look after the people, that's when, of course, you get these dislocations. Yeah. Let's segue China into Australia, because you're based in Australia. The iron ore price is perhaps a lovely way to segue across, given those comments about the housing market in China. And of course, iron ore is a big part of that, and the infrastructure build out. How do you feel about Australia at the moment? You mentioned the RBA getting the silver medal for underperformance in central banking land. How do you feel about the economy? Because there's certainly some positives. It's a land of huge commodities and in probably what is a commodity super cycle. But then, of course, you have some challenges in housing. Where do you see Australia going over the next 6, 12, 18 months?
You actually just summed up my whole view in about a minute, and now I'm going to waffle on for 10 minutes, but I won't do that to you, Chris.
No, not at all. But this is
perfectly.
This is the great thing about these podcasts. I can tap your brain and have some things to say to other people. No, go on.
So resource-wise, clearly we've got a lot of things that the rest of the world really wants at the moment, and one is natural gas. We're one of the great exporters now of LNG. We're also one of the great exporters of coal. And notwithstanding China stopped buying our coal, everyone else in the world wants our coal. So we've got those two things. And iron ore, obviously, very, very, very dependent on what's happening with China. I'm no iron ore expert. I've never been able to forecast the iron ore price. It's a law unto itself. So I would right now hazard a guess that iron ore price should be much weaker than it is. But it's, it has, let's be right. It has dropped a lot in the last 9 to 12 months.
Yeah.
But it could potentially go lower. But at the end of the day, and we've got oodles of lithium, for example. We've got a lot of things here that the world really wants very, very badly. So in that respect, we're the lucky country. But Chris, you and I both know that, and I'm very fortunate. I have got an Australian passport. I've got a couple of others as well, but I've got an Australian passport.
Yeah.
My citizenship will be revoked, Chris, if I say anything bad about the housing market. So with that, house prices here, I've never seen even the top economists of the largest banks and their entire business model is mortgages. They don't really do anything else. They're basically glorified building societies. Their bread and butter is the housing market, and even their own economists are saying that house prices are going to fall 10-15% or thereabouts. Clearly, I obviously think we're going to see that at least, but I don't want to dominate this discussion with any kind of catastrophic house price forecast. Look, I've been wrong on Australian housing for a while, Chris, and I think it has defied fundamental valuation logic now for a while, and you never know. I don't know what could happen, but I'm afraid the housing side is weak, the resource side is robust. Australia will not be immune to what's happening in the rest of the world. So yes, softer economic times ahead of us. And the Reserve Bank, as we know, Chris, Philip Lowe is, now decided to, tighten rates. And I'm afraid
he's got religion.
He's got religion.
He's got religion. It's interesting because, if I think about the mortgage market in Australia, you make a fantastic point. The UK mortgage market used to be almost 100% variable rates. It's now about 25% variable and 30% 1 or 2 year fixed. And then the rest is fixed longer. Whereas the Australian market, I believe, is one of those markets where it's still pretty much all majority of debt is variable rate mortgage debt. So the RBA getting Volcker religion is there's an interest rate shock coming through that system, surely.
Absolutely.
And you would remember, not trying to draw anything too bearish out of you, but in 07, 08, of course, one of the indicators we used to look at around the world was the share of your workers that were in construction. And I haven't looked at this in Australia for a year or two, but I remember last time I looked at it, it was extremely high. So I imagine that kind of setup is all there, is it not?
Yes. Yes. Look, I don't know the exact proportion of the working population that's in construction, because you've got so many sectors and businesses and suppliers that feed into it. It's really hard to separate it out on its own, but it's significant, and the multipliers are very powerful. Very powerful. If you're on a building site, you go and buy a new ute, what we call a ute, and you buy new tools and new uniforms and new boots and everything. It's a huge multiplier coming out of housing. So, look, I'm negative on housing. I have said this in my reports, but you know what? There's so many people that are negative in Australia on the housing market. I haven't really got anything special to add. I'm afraid valuations, of course, they're stretched. I mean, if you do a comparative valuation analysis, which is the mistake I made many years ago, when I actually said to myself, hang on a minute, let me compare Australian house prices with the rest of the world, the United States and whatever. Well, we're multiples of the US house prices. So
yes,
I don't want to get into much of that. Bottom line is housing's going to slow here. It's quite significantly. Yeah.
You should have compared Australian Sydney housing to Shanghai, because I think when we did that comparison a few years ago, Shanghai was more expensive. Shenzhen or Shanghai was more expensive than every city in America, and Sydney, I think, per square foot, which is frankly staggering. I mean, your Sydney house prices are staggering. Shanghai and Shenzhen are even more staggering, considering there's, you know, it's a developing economy in the old sense of the word. But I mean, I know it's a long way along the path, but and Shanghai's a sophisticated city, but quite extraordinary. So, okay, so let's segue from there, because I thought one of the most, there's probably three, in my mind, three geopolitical statements this year. There's obviously been the war in Ukraine, a massive event, but three statements that really define, in the last 12 months, really define the way the landscape's changing. And I wanted to get your take on this. Firstly, the AUKUS deal, which was really quite extraordinary. Then secondly, we had NATO come out, and I think this, you flagged this in one of your reports, mentioned that China was a strategic threat, which, if I'm not mistaken, is the first time they've ever done that as NATO. And that, I think, was the meeting that Japan and South Korea came to, and maybe Australia as well. And then, of course, you know, interesting, we had the Shanghai Cooperation Agreement and all the applications to join. I think Iran has just moved up the pecking order. I think Brazil, I think, is interested in joining. Yep. We've had all sorts of, you know, this sort of emerging group to challenge the West, led by China, who've even been talking about setting up a currency for trade in between them all. So where does that leave you in general on your geopolitical landscape? You talked about the jigsaw and the borders, and you talked about deglobalization. How different is the world today to what it was 5 and 10 years ago? And how will it play out from here, do you think?
I just think it's massively different. And I don't want to sound like one of these think tank people, and I'm actually a member of a think tank, and specializes in China. But the think tank world is really immersed in this, you know, fracturing of the geopolitical order and everything else. And I mean, the people that I'm speaking to in the kind of foreign policy defense arenas are really quite scary at the moment. So
I can imagine.
So go back a couple of years, and if you mentioned the T word, and we're not talking about Trump, we're talking about Taiwan. That was, don't worry about that. Don't lose any sleep about that. You know, that's not going to happen. It doesn't make any sense. Why would China do that? They're immersed in the global economy, integrated. The repercussions would be too great. And I was, by the way, in that camp. So I was an advocate of that. I thought, yes, Xi Jinping, when he first came to power, and then reiterated it about 5 years ago, basically said, I will not leave it to future generations. And he spoke constantly about the Chinese dream. And the Chinese dream is very clear. It is the rejuvenation of the Chinese nation. And the rejuvenation means, of course, the reunification of the Chinese nation. And the one thing I learned about China way back, way back, I was told in no uncertain terms that never, ever underestimate that Taiwan is the reddest of all the reddest lines. There's no ifs and buts, no compromise. But as time went by, people such as myself and many others were very optimistic. I used to say this, in fact, Chris, in 2003 and 4, that the liberalization of the Chinese economy would in time, and I said even perhaps in my lifetime, lead to the democratization of China. I, of course, now have to say that that was hopelessly idealistic, but I am a happy kind of ending kind of guy. You know, I really want everyone to be a happy family. And it's real sad. It's really sad because I've admired China for a long time and really invested a lot of my optimism that China had embarked upon this liberalization, which would eventually lead to political pluralism and the democratization. And that's all now reversed. So when we saw the Russians mass their troops on the Ukrainian border, I should have spoken to you. I don't think we didn't speak exactly at that time, but I spoke to a very, very good friend of mine I said, goodness gracious me, we're sleepwalking into war. Putin's going to do it. And he said, no. All the Russian experts are saying there's no way Putin's going to cross the border. No way he's going to do a full invasion because the repercussions and consequences doesn't make any sense. I said, well, I don't know. And I was not bold enough to say so in my report. Now, the narrative today, the consensus is today, there's no way China will do anything because of the repercussions and the consequences. But then we're not looking at history, because history is littered with autocrats who have done the most ridiculously nonsensical things. And Vladimir Putin did it on February the 24th when he went into Ukraine. And I now am of the view, and I desperately hope I'm wrong, that we will definitely see China attempt to reunify with Taiwan within Xi Jinping's third term. So as of October the 16th, Chris, the clock starts ticking. And whether the reunification is delivered by invasion or strangulation. So what was so interesting is when we saw the response to Nancy Pelosi's visit, is what did we see? We basically saw a de facto embargo or blockade of Taiwan. We saw Chinese missiles flying over Taiwan. We saw some of them landing in Japan's EEZ, exclusive economic zone. We also saw, Chris, and I know I'm going on a bit here, but I spent a lot of time in the Middle East, and I had some wonderful fun with the US military. We used to go on the boats, boating together and whatever. We had a lot of fun. And Bahrain, where I was based, was, obviously there was a lot of US military there. And they were a lot of fun to be around. And, one thing, I'm sure you've been up close to a US aircraft carrier and the strike group. I mean, it's awesome display of power. And America's ability to project naval power to every corner of the world almost simultaneously is unmatched. But note where what path the USS Ronald Reagan took and its strike group took when they started implementing that blockade around Taiwan. Instead of going towards, they went away. Note also the flight path of Nancy Pelosi's United States Air Force aircraft as it left Kuala Lumpur. I'm sure I was tracking it. I think hundreds of millions were tracking it. Instead of flying up across the South China Sea up to Taipei and Taiwan, it went due east and then due north and came in the back door into Taiwan to avoid flying over the South China Sea. Now, we were told in 2015 by Xi Jinping himself, in fact, he said it at a press conference at the White House with Barack Obama standing alongside him. Xi Jinping said, we will never militarize the South China Sea. Well, what have we seen subsequently? And so ironic that two of the sandbanks or reefs that at high tide are underwater are Mischief Reef and Fiery Reef, fully militarized, missiles, the lot. And so what we've got now is a situation where China, this is my opinion, actually now believes it will win a conventional engagement in the South and East China Sea. Now, 10 or 15 years ago, that was unimaginable. And the reason for it, Chris, and I know we're going on a rather long time, never underestimate China's missile capability. And we know they've got these, they proudly call them the carrier killers. So the Chinese realize they can't go toe to toe with the US Navy on the oceans. So they've created this unmatched missile capability. And so basically the US Navy can't get in close. Anyway, I'm out of my depth here on all this, and I don't want to turn this into a thing. But
no, this is utterly fascinating. Go on, finish, please. No,
I will finish. Look, I'm sad to say, and I really regret this. We will see the reunification within the next 5 years. I don't know at this point whether it will be by military means or by some form of submission or strangulation. And I think we saw a kind of rehearsal. And I think the Chinese actually basically told Washington and others, this is what we will do. and you're not going to be able to stop us. I
Mm.
don't think they want to have any military engagement with Taiwan. I think they genuinely want a peaceful reunification, which, as we know, is their priority. I'm afraid, however, in 5 years' time, we might learn that the reunification was a little bit different. So I'm afraid that's always at the back of my mind. But my eldest son always reminds me, he says, Dad, all your geopolitical stuff, when it happens, it happens. Stop thinking about it. And I'm very mindful of that. So the Taiwan issue is always at the back of my mind. And, the Persian Gulf, I love the region, so that I'm always watching that. But I don't let it dominate the kind of action and price action in markets. I'm mindful of it, and I know the tea leaves to look for.
Yes.
If the temperature's beginning to rise.
You're quite right. I mean, geopolitical stuff often doesn't really matter for markets, but this year we've seen a brilliant example of when it does. And that whole new, let's not forget, most of our working careers, we've been living through, the post-Berlin Wall fall and the fact that the world was globalizing. Now the world is deglobalizing and splitting increasingly into two regions. And as you articulate wonderfully, the Taiwan threat is very, very real. The tea leaves, the signs are all really there. And we saw Hong Kong as well. And so I suppose let's segue that into markets as the clock keeps ticking. So, where's the S&P going to bottom and when? Let's just start there.
Okay, I've got a target, and I'm price dependent, not time dependent. So I don't know when, but I have a target, and I'm very simplistic in my valuation of things, Chris. So I've got a target on the S&P 500 of 3,000, and I simply derive that by multiplying the price earnings multiple of 15, which I think kind of feels about right. I think if there's a risk to the forecast, the price earnings multiple will actually go beneath that, because in all prior bear markets, it went well beneath 15 times. And I've got earnings per share on the S&P 500 about $200. Now that's well beneath the market. So yes. 200 times 15 gives me 3,000. I think the first stopping point will be the pandemic panic, pre-pandemic levels of what I'm looking at my screen here. What was that? I just have. Was
it 3.2? If I remember rightly, something like that.
Right. Yeah. Around 3,300 thereabouts, just before February 2020, just before we collapsed, obviously in February around 24th of 2020, was around 3,300, and I think that'll be a battleground there. And obviously we need to take out the 16 June lows, which were around that 3,000.
3.6 and a half.
3.6.
Yeah,
you're right.
Yeah.
But I'm willing to go with the ebb and flow of this. And obviously we've got the Fed meeting tomorrow, and it's all about the press conference, but also about the economic projections of the Fed. So that's going to be an interesting night. I will be up for it.
You'll be watching that. And so tell me, what gets you to, so you got your 15 times, you got your $200 EPS target. I think consensus at the moment is what, 225, 230 or something like that. So your thinking is obviously recession of some sort US globally next year, now, or any sense on timing, or and can you give us some color on that gets you that 200?
Okay, so Europe is, I think, in recession, and once we get confirmation of the GDP numbers and that, in months to come, we'll see that. Europe's a big chunk of US earnings. So you've got a big negative against the scorecard right there. And China's not looking flash at all. So you've really got, from a global earnings capacity of US multinationals, they're seeing all these headwinds. Look at FedEx the other day. They halved. And they'd only updated us in June. And the CEO, recently arrived, or relatively recently arrived, slashes his current quarter in half and withdraws his full financial year forecast. We saw, was it Ford overnight? All the big, these companies are now beginning to tell us that, wow, things aren't as rosy as they were. So look, I'm happy with a kind of $200 EPS for the S&P 500. I think 15 times is being generous. All prior episodes, Chris, you know this better than anyone. Price earnings multiples in all prior bear markets went well beneath 15.
Yeah, I think the most interesting observation about this year, and the market's already down over the first 6-7 months, they had their June low, and the PE ratio got beaten up. But if you looked at the equity risk premium, it was unchanged. And of course, you know, the risk premium in equities should blow out in a bear market, in a recession, but it was unchanged this year. So I like to characterize the first half of this year as just removing the funny money and getting back to normal. And now we're off with the Volcker-like central banks tightening and creating the recession. So you've got to price it in. So, okay, so where does that leave you on the dollar? Maybe the US dollar, maybe the Aussie dollar, euro currencies. Where do you think because, you know, you look at any model on the US dollar, you'd say it looks rich. It looks, everyone's in it, everyone's bullish, but it just keeps going up.
Well, I mean, obviously, let's start with Japan. So obviously, dollar yens has been extraordinary, and I recently started messing around in dollar yen. I just couldn't. It was too compelling for me, Chris. I don't know, 20-something year lows for the yen, highs for the US dollar versus the yen. Obviously, we know what's on the other side of that trade is the BOJ. Kuroda's, you know, in no hurry, and he's going to retire. When is it? Next year sometime. He's not going to do a thing before he leaves. I mean, Kuroda's going to get carried out with no change.
Right.
But the MOF, we know the Ministry of Finance is getting a little bit agitated. So their verbal intervention is becoming a little bit more aggressive, but the market pretty much ignores them. I don't know if the Ministry of Finance will be happy with that. But, you know, at the end of the day, if the market believes BOJ is not going to do anything until Kuroda goes, and the Fed on the other side is doing what it's doing, and we've got Jerome Powell deciding that, you know, his legacy is going to be, you know, Paul Volcker the second. So you've got the interest rate differential. I mean, look, at some point in time, I will get more aggressive with my view that the dollar is going to roll over. You know, the trend is your friend. I get the relative interest rate differential thing. And the other thing people are saying around the world is, you know what, everything looks pretty horrible. And maybe the United States is possibly not looking so good itself, but it's better than everywhere else.
Yeah.
And
do you not think, does it not remind you, I mean, like you, I like to be a contrarian. So when things become stretched on sentiment and positioning, you want to think about going the other way. But it seems to me at the moment, it's one of these times you want to be very careful. It feels more like currency is going to move until something breaks. And like you, as you articulate, the relative monetary policy, BOJ versus Fed, so extreme completely. And the same with the renminbi, really. You could make the same sort of points. Easing or not raising, and of course the Fed Volcker-like. So do you not think it's a bit like the mid 80s, the sort of 84, 85, you know, that we're in a momentum currency world, which is great for the macro traders, and of course just going to go until someone really changes something in a big way.
Chris, you bring back a lot of fond memories. I have many fond memories of the Plaza Accord. I think the dog's made its entrance. You might catch it on camera now, but anyway,
we'd love to see Charlie.
Yeah, Charlie, I don't know where he is at the moment. Well, actually, I don't want to call him over. He's so big, his head will come in about here. Anyway,
we'd love to see him, but anyway, yeah.
No. Plaza Accord 1985 was a lot of fun. That's when I really got involved in foreign exchange markets. I don't think there's any kind of sufficient global degree of cooperation as we saw in 85. And, you know, don't forget the Japanese were very upset by all of that eventually because the yen strengthened. That period, I think we called it Indaka, that period of the strong yen was one of the reasons why Japan kind of had a few problems later on. I just don't think there's the spirit of global cooperation to sell the US dollar. And does America want to sell the US dollar? Because that's at least deflating some of this imported inflation. But the strength in the US dollar is causing havoc in the emerging world, particularly those countries that are importing a lot of food and energy, because those goods are largely priced in US dollars. So Look, I don't know where we are in terms of potential Plaza 2, but when currency markets move the way they are, particularly dollar yen, I find that quite interesting. I have started playing around the edges, but you know, the other day I was the wrong way on dollar yen, and then we saw that CPI print, or the core CPI, and it went off like a rocket, and I literally had to, as quick as I could click, I had to close my short dollar yen position. So look, I'm very nimble and tactical around this. Fundamentally, I understand why the US dollar is where it is. I can't wait to catch the decline. I can't wait to catch the decline in the US dollar.
Okay, so interesting. So we're coming to the end of our time. Let's 2 quick questions to wrap us up before we go, and then hopefully we'll get a little sight of Charlie at the end. But those 2 quick questions. So you know, question number 1 is, something's going to break. What do you think? What's your sort of wild outside guess of what might break, or what sort of things could break? Question number 1.
I'm actually really concerned that the breaking could involve, very unfortunately, some form of kind of social unrest, and governments. I just don't like this political polarization. I mean, I honestly believe we've got this perfect confluence, you can call it a perfect storm if you want, of everything happening right now. Whether the stock market does an 87, I don't know. There's a huge amount of this passive money, index money. The big fund managers, you know them all. I mean, they've kind of gone cautious, and they're saying they're conservative, but they haven't actually sold that much. The retail investor in the United States, they're still pretty optimistic. And don't forget, we had the retail investor in the United States, and then we've had the retail investor in South Africa, in Turkey, in India, in South Korea. We had a 13-year-old speculator in South Korea, became a hero with a YouTube following of millions of people because he was giving stock tip advice. You know, so I mean, a lot of that bubble has burst. I think you referred to it earlier as the real funny money has kind of disappeared to a certain extent. Look, I'm a bit concerned about the architecture and structure and stability, because the one word we haven't mentioned, and we haven't got time for it tonight, Chris, is debt. So we've not just got all the things that we've talked about, we've also got the highest amount of debt we've ever had. So we've got this stagflationary debt situation happening. And I don't think any of us have seen, in fact, I know none of us have ever seen anything like this before. And that's why I keep saying to people, be nimble, be flexible. When the facts change your mind, and don't get too rigid about views here. There's a lot of, this is the most wonderful intellectual challenge any of us have experienced, Chris.
That's a great way of putting it. That's a very upbeat way of putting it. And second question. So if you had to put a couple of trades on, I mean, literally they could be 2 days, 1 week. I mean, not 2 days, because by the time we get the podcast out, it'll be too late. But, you know, 1 or 2 weeks, couple of months, or longer term, what would you do? What would you be sort of top 1 or 2 or 3?
Yeah, look, I've been long puts in the US. I've been trading the US from the short side. This is the trader in me talking now, not the public speaking.
Yeah, trade is good.
I do say some of this in my reports, but as a trader of the markets, and I love the markets, as you know, I've been trading this from the short side. Believe it or not, heaven forbid, Chris, in May, June, some of these really specky, frothy names bottomed in May. I mean, I shocked all my subscribers, Chris, when I declared I'd been buying Cathie Wood's ARK Innovation Fund. Some of them wrote to me in a state of shock. I was buying Zoom down 86%, buying NVIDIA, heaven knows how much that was down. And some of the really specky names, I shouldn't say NVIDIA specky, but some of the bombed out names for a tactical bounce, some of them went up 35%.
Yes, and more, I think, and more.
And more. So I'm never shy to do that, even though I've got a structurally strategic bearish view. I'm willing to play.
What are you doing now? What's the sort of 1, 2, or 3 trades? Or I mean, maybe you don't have any strong conviction at the moment.
You know what, Chris? I probably have the least number of things going on that I've ever had. We've got this Fed meeting. I think he's going to be higher for longer. as per Jackson Hole. By the way, as you know, Chris, everyone needs to read, and I know you do. Nick Timmerus at the Wall Street Journal is the individual that is.
He's the mouthpiece. He's the new guy, isn't he? I was trying to remember who the guys were we used to read. I can't. My memory's so poor these days. But there was always
John Hissenrath was one, I think.
Oh yes. There was one or two others. But yeah,
Nick is the new mouthpiece for the Fed, for them to manage market expectations. So he hasn't given any clues away, although he's implying the higher for longer narrative and a consistent message from post Jackson Hole. And everyone else at the Fed has basically been singing from the same hymn sheet. It would be a surprise to me if Powell kind of hinted anything else or other than that higher for longer. I think he needs to stick at the higher for longer for a little bit longer.
Yes.
And then let's see what happens next. But by next year, things are breaking. And so clearly the Fed will start having to pull things back. As things break, and they're breaking already in Europe, I'm watching out for that very, very carefully. So look, right now I'm very open-minded.
Yeah, there are times not to overdo it in markets. You're right. There's a time where the best, it's about return of capital rather than return on capital. So actually being cash at times does have some sense. So you must as we draw to a close, can we meet Charlie? Can you get him into the shop for us? That'd be lovely. Is he, or is he fast asleep? He's fast asleep.
Come here.
Can
you see him there?
Oh, not too well. Oh, there we go. There he is, having a bit of a snooze. Fantastic. Fantastic. He's not going to come. Anyway, JP, come back into shot. Thank you. Just to say, thank you very much. I really appreciate it. If people want to get more of Jonathan Payne, you have a website. I think, is it thepaynereport.au?
No, thepaynereport.com.au.
.com.au, and we'll put a picture up on the screen now so people can see it, where they can subscribe to your fantastic weekly letter, which you kindly send to us. I think we send you ours as well, if I remember rightly.
Absolutely, and I read all your research every week, Chris, and I absolutely love it.
Likewise, and you are on the nose on so many things and raising so many issues up when the market isn't thinking about. So appreciate that. And you are a data junkie, and you seem to go to places that no other letter writer goes, in a good way. So thank you very much. I really appreciate it. It's been great talking to you, and really enjoyed it. We'll have to do it again sometime. Come back and talk about debt. Goodness me, we can have a good conversation about that. So, Jonathan,
Chris, I always love our conversations so much, and I really, really want to see you here in Australia. And thank you. I really enjoyed this evening, and as I said, I absolutely love your research notes that you put out every week.
Thank you very much. All the best. Appreciate your time.
Cheers, then. Bye-bye.
Brilliant.
Bye-bye.